Welcome back. A lot to unpack this week, a lot to talk about, especially around the condo space here in the GTA. What is happening with investors as a recent report talks a little bit about the challenging times facing the condo market. Want to take an opportunity, unpack our thoughts and opinions on what this could mean for the broader Canadian economy. More importantly, what could it mean for the Bank of Canada? Is this a canary in the coal mine? We'll unpack our thoughts and opinions this week. We welcome you back to the channel. If you have not subscribed, please go ahead and consider subscribing. Hit that notification bell as well. Don't forget to leave your thoughts, questions, and concerns in the comment section below. Now let's dive into this article, this publication report by Urbanation, Sean Hillenbrand, and Chief Economist at CIBC, Benjamin Tal. It is a GTA condo investment report titled Challenging Times, and challenging times it is for a lot of condo investors right now. Now, a lot of the data that is being showcased in this report is really not new to us, especially those who've been following along the channel as we talk about where investors are headed as they're departing the condo market. Developers are facing significant headwinds, but I think it just reinforces the argument that we've been talking about, that there could be a lot of headwinds in front of the current Canadian market, the economy right now, especially when it comes to condos, what it means for employment. So first and foremost, just to really touch on what this publication, this report sort of talks about, it says that investors are offloading a lot of their properties. I think we're sitting at around 6.3 months of inventory in the GTA condo market right now. That's a lot of inventory. As that inventory continues to pile up, definitely going to have some downwards pressure on prices. And this is obviously not good for investors, but maybe a golden opportunity for Canadians that are looking to gain entryway into their first piece of real estate, buying a home for them to live in. As these prices continue to maybe fall a little bit further, we'll see exactly how that plays out. But a lot of Canadians are still facing significant pressures from affordability, obviously qualifying, having that down payment. And we'll talk a little bit about qualification, because right now, if you may recall, back in April, the budget was tabled for the Liberal government, and part of their conversation was increasing the amortization for insured mortgages to 30 years, but only for newly built, newly constructed homes. And if you recall, that conversation was really pushed forward and lobbied by the developers and the builders, because at that particular point in time, I do believe, or prior to that even, they saw the potential writing on the wall. How are we going to get end users buying in to these new construction or newly built homes, maybe particularly in the condo space, when they're facing significant challenges and developers and builders are having issues actually getting buyers? Now remember, developers and builders, those projects that we see in downtown Toronto, the majority of them were purchased by investors. Investors made up a huge pool, probably well over 50-60% of those units were sold to investors. Not many were end users. And with that, you have to think about how a development, how these projects come to light. I mean, they have to do what's called a pre-sale. They have to sell these units before they even get their financing, before they even put a shovel in the ground. A lot of these buildings, a lot of these units have to be sold. They have to have 70% of their units sold on paper prior to getting additional resources and funding for construction. And that is a big problem when we see higher interest rates, higher carrying costs. I mean, as Canadians with mortgages, you're feeling the pressures from higher interest rates. Builders and developers are feeling some of the same pressures as these interest rates remain higher and elevated. They have been for some time now. And obviously, these are some of the impacts. These are some of the lagging indicators. As the interest rates remained higher for longer, it took time for those particular higher interest rates to really slow the economy down, and that they did. As the developers continue to face these headwinds, there's not a lot of projects coming to the forefront. Now, before we get into my thoughts on the developers, I think it's important to understand what's happening with investors. I mean, there's two types. There's the ones that bought prior to 2020, those that have owned units and condos prior to the pandemic, and those that have purchased them afterwards, those newly built ones. Those investors that may have purchased units prior to a lot of these increases, where we saw these prices go parabolic, where we saw interest rates at a significantly lower price point. These individuals are facing their mortgage renewals potentially, or have already renewed into higher interest rates, and they're looking at their carrying costs. A lot of these individuals may have no problem carrying these rental and mortgage payments together, especially when you look at all these components that are added in. You have to think about your mortgage, what you're getting for rent. are you shortfalling? How much you're shortfalling? Then you have to add in things like, hey, you have insurance on that unit. You also have to have your maintenance fees. You also have to think about your property taxes. And if you have someone managing that unit on your behalf, then what those costs look like. And some individuals were able to manage those payments when interest rates were lower, but as interest rates continue to stay elevated, as many Canadians renew this mortgage renewal cliff, they're looking at that particular payment. They're looking at potentially their existing mortgage on their primary residence that could be renewing simultaneously. A lot of individuals leveraged from their homes, their equity, their lines of credits to get into these units. So they have to weigh out those costs. That could be a major push factor for a lot of individuals to say, hey, I'm done. I'm going to just sell this unit. And these individuals that own them for quite some time have a bigger profit margin. There's a lot more equity built into that property. They can afford to sell it for less, take a little bit of a haircut, as opposed to maybe those who bought them more recently or have yet to close. I mean, those are the other set of investors who bought on paper with the intention to close or maybe flip it on paper, make a small fortune, as they purchase those units at a much higher price per square foot. And when you start to compare them between what's on the market, these older units to the newer units, well, those price per square foot, it's just don't align. Appraisals are not coming in. People are walking away from these new construction homes. And obviously developers are feeling the pain of that as they try to maybe go after these individuals. But ultimately, what does the developer do? In these particular cases, is there going to be any bailouts for them? Is there going to be any support? We talked about those 30-year amortizations. I wonder if that's going to be a tool that they're going to try to deploy to end users. But at the end of the day, these pre-construction homes, these pre-sale homes are a big problem, because if developers don't see the capacity to build new homes at a reasonable price, obviously with the cost of permitting, the cost of bureaucracy, the cost of taxes, development charges, all these things make it more expensive for them to build. People aren't buying, recessionary fears, unemployment ticking up. Obviously, builders, developers, they're going to pack up. They're going to finish the projects that they have already been committed to complete and then walk away. And that's literally the consensus that we hear not only in the condo space, but also in the single family space. As a lot of these projects, once they are permitted, they have a very short shelf life where they have to complete. And if they're just not feeling that people are buying, what are they going to do, right? Development, building, construction, real estate makes up a huge component of the Canadian GDP picture. It makes up around 20% of GDP here in Canada. And that's a huge, huge amount. If we think about if these developers, these builders, these projects don't get initialized, what happens to the construction industry? What happens to all these skilled trade workers that were supposed to build these 3.1 million new homes by 2031, according to the Trudeau government? I mean, yes, we're still not building enough homes. New housing starts are falling off a cliff because developers aren't coming to the market. This is going to be a long-term problem. But if you recall on the channel, we talked about several months ago, we were talking about how we don't have enough skilled trade workers to build the homes that we need. But now all of a sudden we have no projects for the skilled trades to actually work and build. So there's another problem, another unintended consequence, and that will add into the unemployment numbers. Eventually, if these builders don't hire, new trades, they're not hiring people to staff their architectural, engineering, all the things that are required from the developer, the back office stuff is not being pushed forward. They're going to lay these people off as well, potentially. So there's a big, big problem that I believe is brewing right here. And the condo market, what we're seeing happening in the GTA is maybe just a little bit of a glimpse into the bigger picture. Now, it's important to understand that that is one segment. Condos, what developers have been building, are not really geared to end users, at least from my opinion. A lot of individuals don't want something that's under 400 square feet. These were purpose-built for investors to gobble up at a certain price point so they can rent them out. A lot of families do not want that type of home, that type of small space. It's just not adequate enough for a growing family. And with new arrivals coming to Canada, I mean, that particular unit is not going to really meet the needs. Maybe short-term options for them to maybe rent for a little while, But to really own and grow a family, it's not adequate. And what we talk about is the missing middle. Why are we not building the homes that Canadians need and want? Is because developers were focused in just on investors. And I think there's a new shift happening when we look at single family homes. And that is what we've been seeing happening right now is a lot of individuals are selling their smaller units. If they've been able to get out of the condo market and they have a unit that's desirable. I mean, we need like units that are probably in and around the 900 to 1,000 square foot range. That's an adequate space that maybe you have people that are downsizing, selling their homes, moving into a condo. But ultimately, what they need to survive, it's not 400 square feet or less. It's generally a little bit larger. I mean, that is literally based on people's needs and wants. But from what we're seeing, young families that are starting to, try to grow a family, they're getting married, they're engaged, whatever the case is, they need more space. And they're saying, well, I can buy a condo for this price point, but I can also buy a house a little further north, east, west, south of the city. And I can actually have a little bit more time, longevity, a longer horizon in that home. And they're looking at the longer term picture. Instead of 5 years, they're looking at 10 to 15 years. And our argument, our conversation is, yes, that's really important. The fact that you have that longer horizon you have the ability to avoid exposure and volatility. The longer you're in a home, the less likely it is to, see some depreciation. The longer you ride that out, you build equity, you pay down your mortgage. Remember, you marry the price of the home, you date the rate. If you're buying something for a short window of time, you have to think about the duration, right? You're buying it, volatility, the market, as we've seen. Then you have to think about when you sell that unit, the commissions on that unit, how much you put down in that unit. Are you able to leverage that equity once you're cashed out and buy something bigger? So ultimately, some clients are maybe looking to stretch their budget a little bit, buy something a little bit bigger where they have a longer time horizon. But the ultimate problem is they're not building single family homes. That has been something that a lot of builders have pushed to the wayside as they focused in on investors and very small units, because those are easy to build. They're more cost effective. Building up is better than building out, because the cost for a developer and a builder to build out is more expensive because they have to build more infrastructure. We've talked about it on previous episodes before. But ultimately, at the end of the day, I really think we're going to be seeing some significant headwinds. I think the Bank of Canada overall is going to see this data. The broader economy is going to face issues with unemployment. I think we're going to get higher unemployment numbers as the construction industry slows down. And we're definitely going to see the Bank of Canada having to cut as growth as a result of less people working, less people spending, recessionary pressures. I believe we're already in a recession. It just hasn't been indicated yet. The numbers haven't been publicized, but I really think when you see this low growth, this very, very stalling out of growth, the Bank of Canada that's literally on the cusp of cutting further just to keep the economy alive. Remember, interest rate hikes helped slow the economy down. It took time. It took a long time. Those cuts are not going to happen overnight, right? The cuts, even if they cut a lot today, it's going to take months and months and months for those cuts to actually bring the economy back up to life and back online. And ultimately, what are the unintended consequences of that? I mean, as we look at the real estate market, Canadians that could be on the sidelines waiting. Ultimately, we'll be tracking all that here. We'll be looking at all the data. So make sure you are subscribed to the channel. But let us know your thoughts, your opinions, and your concerns in the comments section below. Did I miss something? Let me know. But we'll leave the video here. Wishing everyone a wonderful Friday and an even better weekend ahead. Thanks again for stopping by.